Shriram Transport Finance, that's the one in focus. Mr. UG Revankar, MD of the company, joins in on the show. Mr. Revankar, hi, morning. The SIAM data for April to Feb 2013, that is, has shown that sales of medium and heavy commercial vehicles have been down about 23%. Now, you have high exposure to the CV space. When do you see the CV cycle actually turning around?
I think it should take some time before turning around because, see, what happened is the last 2 years, bulk goods transportation, especially in mining and coal, has come down. And many of the vehicles which were being used there in that activity have moved into haulage. So there is a little overcapacity built in haulage. So the demand came down and the sales year on year came down in your commercial transportation, that is haulage. So I feel unless this mining and coal get activated totally. In fact, there are some instances where some mining activity have been started in Karnataka, and coal, there is some talk going on where captive coal mines are being activated. If these are activated totally, probably from October onwards, there should be turnaround and the demand for heavy and medium should come back.
Do you agree with CRISIL's assessment? CRISIL yesterday has indicated that at a time when the economy is going through a rather, slow growth, it is a matter of time NPAs in the CV segment will go up.
See, CV segment stress, especially in heavy vehicles, was visible for nearly 1 year now. It is not just a recent phenomena, because as the industrial production came down, the goods movement were little slower and little overcapacity was built. So there was some stress on the heavy vehicle movement and especially earnings. But it has not impacted the normal other CVs, especially smaller LCVs, which is typically carrying day-to-day essentials, farm goods, and to the last mile connectivity. So these are two different segments altogether. So where the industrial production related transportation, you have some stress, especially if you had taken a new vehicle finance. In a new vehicle finance, what happens is your EMI is around 55,000-60,000 rupees per month. Whereas if you had taken a used vehicle in the same segment, your EMIs would be 30,000-40,000. So what has happened is people have been content with using the used vehicle or not really buying a new vehicle. So somewhere not adding new vehicle has helped to maintain the momentum. But wherever people have added a new vehicle, probably there I feel the stress levels would have been little higher. So it is it has been over the last 1 year, but especially looking at our portfolio, I don't see any much stress beyond what it was probably around 2 quarters back.
So let's start about your company financials right now, because your gross and net NPAs have remained stable on a sequential basis. However, there is a slight drop when it comes to your coverage ratio. What is the stability or rather reason for stability in the gross NPA trends, and is this sustainable?
See, we are in a niche segment of used vehicle and small commercial vehicles. In the used vehicle and small commercial vehicle, the ticket size being small and it is dispersed with a lot of individuals, most of the individuals who operate these vehicles. You will not have big changes in stress level because it is distributed, and since they are carrying essentials and it is a cash and carry business, mostly you will find it reasonably stable, even though our gross NPAs are at around 3%. So between 2.8 to 2.3, around 3%. It has remained at that level, and I expect it to remain at that level for some time to come. I don't see any drastic change either in the worst side or maybe improving immediately, because people who are already in the harder bracket would remain there for some more time till the economy improves.
So if you're confident of maintaining your NPAs, do you think growth could take a hit?
Yeah.
Because historically I've always seen when there is stress on the economy, companies who focus on NPA management take a hit on growth. For those who hunt for growth, they take a hit on NPAs.
It's not so. In fact, our credit growth has been very good in the Q3, and Q4 credit growth is even better. What is happening is, since people are looking at used vehicle as a viable proposition at this time, people are more and more turning towards used vehicle. And another advantage is used vehicle resale prices have not come down because of this sustained demand and less supply of a new vehicle. So the demand for used vehicle and small commercial vehicles, which is a last mile connectivity, and because today rural prosperity is better, agricultural produce is better, agricultural return is better, there is much more demand from the rural market. And we cater to the tier 2, tier 3 cities, and also we have focused recently in the rural area. The demand credit growth has been quite good compared to same quarter last year. In the Q3 we had around 30+% growth, and even this year I am expecting around 30% plus growth compared to Q4 of last year.